What is going on, guys? Nick here, back with another video. Earnings season's here and we have another big week of earnings reports. So the first stock we're going to take a look at is PayPal. PayPal announced earnings on February 1st and investors weren't too happy with what they saw. Over the last 9 months, PayPal stock has been really struggling. The stock hit all-time highs in July of 2021 and has continued to sell off since then. After the most recent earnings report, the stock dropped another 25% in a single day to just $130 per share, putting it at less than half of its value last summer. So what happened? Well, two big announcements came. First, PayPal lowered its 2022 profit outlook. PayPal expects that for the full 2022 year, revenue would grow by about 15 to 17%, coming in short of the 18% analysts had been forecasting. PayPal's seen the transition away from its partnership with eBay, inflation reducing consumer spending, and supply chain issues impacting cross-border payments all impact its top and bottom lines. On top of this, PayPal announced they were going to abandon the 5-year financial targets, which they had announced only a year ago. They were aiming to grow to 750 million active accounts by 2025, which would be double the amount of accounts that they had at the time of the announcement. They were also targeting $50 billion in revenue, which would require the company to grow at about 20% annually. So on February 1st, PayPal reported its fourth quarter earnings. PayPal reported earnings of $1.11 per share, missing the $1.12 expected, and revenue came in at $6.92 billion versus $6.87 billion expected. On top of this, PayPal, as I said earlier, announced a lower outlook for the next quarter, where they anticipate 87 cents per share versus the $1.12 that was expected. Now, when we look at how this quarter looks, the red on this chart is the earnings they just reported, and each full bar represents a full year of earnings from that date. So we can see while PayPal did see a good amount of profit growth since the beginning of 2022, it basically peaked about a year ago and has been coming back down since then. Now, looking at the past decade of revenue and net income, things don't look quite as bad, mostly because we're looking at a more zoomed out version of similar information. Overall, the company has continued to grow its revenue and profits, but between 2020 and 2021, PayPal has seen a slight decline in profit. Okay, so when we look at their expenses, we can see that just under half of their costs are associated with the actual transactions expenses. The rest is pretty standard operational expenses, but I do want to point out that the blue bar, the transaction and credit losses, increased by a lot as you would expect during 2020. These are basically the expenses from fraudulent transactions and their buyer and seller protection. Well, that expense throughout 2021 wasn't just lower than 2020, it was also lower than 2019 as well. Now, this is where things get pretty interesting. When I looked into the finances, PayPal included some pretty interesting graphs in their 10K. The first is their active accounts, which a lot of people made a big deal of since they missed their targets and probably won't hit that 750 million accounts by 2025. But even with all of the concerns about how PayPal continues to grow going forward, it seems pretty clear that they're still attracting new customers. They also reported the number of payment transactions has increased by a lot. Now, 2020 was a down year in terms of growth, so this jump may seem a little more dramatic, but the number of transactions between 2019 and 2021 increased by about 56% or 28% on average per year, and the total payment volume jumped by 75% or 37% per year. So why is PayPal's income so much lower than last year? And why does earnings look like it's declining while everything else looks flat? Well, this is something that I try to avoid showing just because graphs are a little easier to digest, but I think this is an easier way to show it. If we look at PayPal's operating income, which is their revenue minus their operational expenses, so the things that you see here on this chart, we can see that PayPal has increased its operating income pretty consistently between 2019 and 2021. 2.7 billion to 3.2 billion to 4.2 billion. Then comes a lot of odd charges and incomes below. What sticks out is this line right here, which is other income net. It went from a $297 million gain in 2019 to 1.8 billion in 2020 to a $163 million loss in 2021. Now, these are actually their stocks and other investments in private companies that PayPal owns, or at least owns part of. On their website, PayPal explains that they invest in innovative fintech companies, and since a lot of other disruptor fintech companies dropped by a lot in 2021, it kind of makes sense that they lost some money here. So if we just go back and look at PayPal's operating income, we can actually see a business that's continuing very strong growth and actually isn't slowing down at all. Now, looking at the current forecasted earnings for PayPal, we see that they're projected to continue growing going forward, going from 25 billion in revenue and 4.1 billion in profits in 2021 to 42 billion in revenue and 8.5 billion in profits by 2024. When we look over revenue growth, it seems like PayPal is a little cyclical in its revenue growth, but over the next few years, they still project to be between 15 to 20% going forward. Now, a growth rate of 15% comes out to a fair PE value of 34, and a growth rate of 20% comes out to a fair PE value of 53. When we look at macrotrends.net, we can see that PayPal seems like they got pretty far ahead of what it should be worth in 2020 and 2021, with the PE rising between 50 and 80, which is definitely too expensive for this company. However, we can see that the current PE of 29 is the lowest that we've ever seen, 2019, and it's below our low-end fair value. So when we look at this valuation charted out, we see that PayPal has absolutely sold off too far. Right now, it's extremely cheap if the forecasts hold up. But what if PayPal doesn't keep up the growth? What if it underperforms what's currently expected? Well, let's say PayPal drops between 12 to 15% growth going forward. Well, that brings the PE range between 26 and 33. This actually still puts PayPal in a fairly value range with a 2024 upside between 50 and 91%. So I think that PayPal may be facing some headwinds right now in terms of a lot of competition coming forward. However, the current sell-off putting the stock at 125 per share is definitely too far, and PayPal is absolutely undervalued. If you own the stock, be patient and hold on because this stock will recover over the next few years. PayPal at this price is definitely a buy. Okay, so the next stock on this list is AMD. AMD reported earnings on February 1st, and the stock ended up having a pretty good jump after earnings came out. AMD reported record revenues and has continued impressive growth even with all of the chip shortages and supply issues. I actually think that AMD might have benefited from the supply chain problems because that chip scarcity seems like it's driven up a lot of the chip prices. We'll take a look at the segment performances later, but AMD has seen 32% growth in their computing and graphics segment, which AMD does say was driven by their Ryzen processors and Radeon graphics processor sales, and that the average price for both was increasing on an annual basis. AMD also saw strong growth in the cloud servers and gaming console segment, which grew by 75%. They also finally received approval from the Chinese authorities to complete their purchase of the Xilinx deal they announced in 2020 for $35 billion in stock, which leaves only one remaining roadblock, which is FTC approval. AMD's also said that it has the production capacity it needs to grow in 2022 and spent over $1 billion in 2021 to protect its long-term production capacity. AMD's earnings came in at 92 cents per share versus 76 per share expected, which is up 26%, and revenue came in at $4.83 billion versus $4.53 billion expected, which is up 50% year over year. So when we look at how this quarter looks in context to the rest of its earnings, we can see that this was a pretty substantial quarter, with it coming in higher than what they were making on an annual basis before September 2020. Now looking at the past 10 years of earnings and revenue, we can see AMD has really surged over the past couple of years, and it's clear that Lisa Su and the great AMD turnaround is still driving on. Now when we look at their revenue versus expenses, we can see that AMD spends about half of their revenue on the cost of revenue. However, it is a little hard to see on this chart, but AMD has actually seen their cost of revenue decrease in relation to its revenue, which is also called gross margin. It's gone from 51% in 2019 to 57% in 2021. However, I think this probably has to do with the increase of the price of chips, so I don't think that this is something that you can depend on in the future. So when we look at their segments, we can see that computing and graphics is definitely their bigger revenue segment, but still both actually contributed a pretty good amount of profit over the last year. Embedded and semi-custom actually had a huge jump in profits, going from $400 million in 2020 to $2 billion in 2021. AMD said that they saw this driven mostly by server chip and game consoles. When we look at their forecasted revenue, we can see that AMD is projected to continue pretty strong growth. By 2024, AMD expects to grow from $16 billion in revenue and $3 billion in profits to $26 billion in revenue and $6 billion in profits, so about double today's profit. Now, when we look at AMD's growth, we can see that analysts project growth to slow over the next couple of years with around 11% growth. So to value them, let's use a growth rate of 10% for the bottom end of the range and 13% for the top end. This puts AMD's fair value somewhere between a PE of 22 and 28. When we look at this valuation charted out, we can see that AMD is fairly priced right now, probably a little bit on the high side. I don't think that it has quite as much long-term upside as I think a lot of others are expecting. And right now, I would say that AMD is going to have to really beat a lot of the expectations currently projected for them over the next few years for the stock price to grow. So right now, I would say that AMD is a hold and maybe even a slight sell if you have something with more upside that you want to invest in. It's not a very expensive stock, but I do think it seems like it has some limited upside right now based on the current projections. Okay, so the next company on this list is Google. Now, Google made a big announcement that they would reduce the cost to buy an individual share of their stock at some point this year. They announced a 20-to-1 stock split, so if you own one share, it's going to be broken into 20 shares. It's sort of like if you held a $20 bill and somebody split it into $21 bills. Now, there's been a few big stock splits that I've watched closely over the past couple of years. For example, when Apple and Tesla both split their stock in 2020, the stock saw a really huge rally before the eventual split. Then they both experienced a little bit of a slump before returning to higher highs. Now, Nvidia also announced a stock split last summer, and the stock also had an incredible run between the announcement before the actual stock split actually took place. Now, there's definitely some differences between Nvidia, Tesla, and Apple when they did their stock splits. The market was a lot more bullish in 2020 with the meme stocks and the small cap stocks hitting new highs, and I also think that Apple and Tesla were priced a little high, but relatively fair valued at the time. When Nvidia NVIDIA split, we saw the run-up which occurred when the market was still extremely bullish, but post-split is about when the market became more neutral, at least as far as meme stocks and the small cap stocks, which I think was the same type of investor who was buying up these stocks during the split. Now, NVIDIA did see a continued run post-split, but the stock did sell off, and since then has returned to its price around the split. I think the issue for NVIDIA was the stock was really just too expensive in the post-split surge, and in November, I actually made a video about how I sold my NVIDIA shares because I thought the stock was too expensive, even though I liked the business. I definitely took a pretty good amount of thumbs downs, but it does look like that I sold near the top. So I think what we need to consider for Google is this. Is the current valuation low enough to support a massive run-up without becoming overly expensive? And will there be enough momentum to drive a run-up of the share price? So let's take a look at the valuation first. So Google reported its earnings on February 1st, and they reported earnings of $30.69 versus $27.34 expected. They also reported revenue of $75.33 billion versus $72.17 expected. Google also saw one of their biggest winners, advertising revenue, at $61 billion, which is up 33% from the $46.2 billion they earned in the same quarter last year. So when we look at this quarter compared to the rest of their earnings, Google has continued as the growth machine that we've seen in the past. That $30 per share in red looks like a very solid quarter and seems like the continuation of the previous trend. Now, when we look at the last 10 years of revenue and profits, we can see pretty much the same growth trend reflected in the earnings per share growth. What's incredible to me is that even at $182 billion in revenue in 2020, Google was able to grow by almost 30% for the full year earnings and almost doubled their profits, going from $40 billion in 2020 to $76 billion in 2021. When we look at Google's revenue versus expenses, their cost of revenue is just under half of their revenue, which gives them the ability to have such high profit margins. Google spent $31 billion on research and development, which you can see in blue in this chart, and it hardly looks like anything. So when we break down their segments, I was surprised to see the Google Cloud segment actually doesn't produce any profit. Google actually loses between $3 to $5 billion on that segment a year, while it only brings in about $9 to $19 billion in revenue. Now, the real star of the show is Google's services business, which is made up mostly of their ads business. It brings in all of their profits and almost all of their revenue. Over the past year, Google Services brought in $237 billion in revenue and $91 billion in operating profits, which is a really insane number. When we look at their forecasted earnings, Google is expected to continue growing from $257 billion in revenue and $76 billion in profits to $398 billion in revenue and $101 billion in profit by 2024. When we look at the forecasted growth for Google, the current expectation is for them to slow down between 14 to 17% over the next couple of years. At that growth rate, that would put Google's fair value between 31 for the bottom end of the range and 41 for the top end of the range. However, when we go over to macro trends, we can see that Google typically trades towards the lower end of this range, around 30 to 25. So if we use my fair PE values between 31 and 41, that puts Google at an extremely cheap valuation, with the stock currently worth about $3,400 to $4,600 based off the current earnings per share, and a 2024 upside of $4,700 all the way up to $2,686 by 2024. Even if we use a more conservative valuation with the PE ratios the stock has recently traded around, we can see that still puts Google around the bottom end of its current fair value range. By 2024, this puts their upside around $3,800 or 33% higher than today's share price, and a top end of the range around $4,600 or 60% higher than today's share price. So Google is definitely a buy right now. I think it's very possible that as we get closer to the stock split happening, that a lot of people for whatever reason are going to buy up the stock just to see their shares that they own go from 1 share to 20 shares. Again, stock splits really don't change the value of a stock, but what we can definitely see from this valuation is Google is absolutely undervalued right now. Okay, so the next stock on this list is Meta. Now, Meta, or Facebook, reported earnings on Wednesday, February 2nd, and the stock dropped by 26% after the announcement, leading to a huge $20 billion loss in value for the company, which is actually a new record for the largest one-day drop in value in the stock market's history. Now, there's probably been the most insane number of headlines that I've seen come out after this earnings report, with every stock genius in full 2020 hindsight mode saying that Meta's been doomed and this was obviously going to happen. However, on this channel, I try to desensationalize a lot of these things and give you guys accurate information in full context so that you can get a complete picture of what's actually going on with the company and not just a bunch of lazy reported stats that may explain current parts but won't really give you the full picture. So let's look into the report and figure out if headlines like this, Facebook stock crashes after user base starts shrinking, it's one of the worst crashes on the stock market history, is true. Okay, so here's what Facebook actually reported. Earnings per share came in at $3.67 per share versus $3.87 expected, which is an earnings miss. Revenue came in slightly higher though at $33.67 billion versus $33.4 billion expected. Daily active user growth came in at 1.93 billion versus 1.95 billion expected. Now, just to put that in context, the whole world has a population of 7.9 billion people. So 1.93 billion people using a Meta app daily is a massive number. Those daily Facebook, Instagram, and WhatsApp users are about 1 out of every 4 people on the entire globe, which does include people who live in parts of the world with no internet access. Facebook's revenue and guidance for the first quarter of 2022 came in at 27 billion to 29 billion, which is short of the 30.15 billion expected, which would be somewhere between 3 to 11% growth from last year. Now, what's happened is Apple made some changes to their privacy settings that have hurt Facebook's ad business uniquely compared to Google. During the earnings call, Mark Zuckerberg said that Apple's ad tracking transparency feature, or the ATT, is going to cut out about 10 billion in profits in 2022. So let me explain how that's going to happen. Your Apple devices have identification for advertisers called an IDFA, and this is basically what Apple uses as an ID for advertisers to understand what you're interested in without identifying you personally. So for example, I recently turned on all of my ad tracking to test out signing up for focus group interviews. After I turned on my ad tracking, I just started Googling focus groups until basically all of my Facebook and Instagram ads show up as paid surveys, medical research, or focus groups. Well, the advertisers don't know it's Nick Daly searching for focus groups 15 times in 45 seconds. They just know that this particular ID is very interested in focus groups. Now, the problem is that because so many people have opted out, Facebook isn't able to target its users as well. So if I had kept all of my ad targeting on, in theory I could have done the same search, but it wouldn't have given me all the focus group ads that I'm now getting because advertisers wouldn't have the information to know I'm very interested in focus groups. Now, Apple has introduced a replacement for their old ad tracking system that's still more privacy friendly. Still, Meta and Snap have said that it's less efficient than the previous version. So the bigger issue for Meta is they don't own the platform that customers are using Meta on. If they can only access customers through Apple devices or Google devices, they're sort of at the mercy of Google and Apple. And Google's business is way different since it's ads that are served when somebody's actively searching for something, basically telling advertisers what they want to see, versus Facebook, which actually has to figure out what types of ads consumers are likely to interact with. Now, some analysts are claiming that customers aren't able to get the same return on investment for Facebook ads, so they've ended up buying more Google ads. Now, there's no concrete information stating this, but the idea does make sense, and this is something that we have to pay attention to. Okay, so the red part of the bar is the last quarter of Facebook's earnings, with the 3 quarters before giving you the full year of earnings for each quarter. Now, this definitely shows flat growth as Facebook tries to figure out how to navigate ad tracking better, so not a great sign. Still, in all seriousness, the situation could have been much worse. However, when we look at the full year revenue and net income for the past 10 years, it's pretty hard to tell that anything happened bad on this chart, and from here it actually looks like Facebook is continuing along as normal. Now, when we look at the revenue growth versus expenses, we can see that Facebook actually has almost no cost of revenue, which does give Facebook some room to work with. If advertisers using Facebook ads are going to experience less efficiency in their ads, those bids for the ad slots will come down over time, which will decrease some of Facebook's gross margins. Now, Meta's segments aren't too surprising. They're actually pretty dominated by the family of apps segment, which makes up all of their profit and revenue. But I want to point out that the Reality Labs segment has a long way to go and it's entirely supported by the ad business. Last year, they actually lost over $10 billion on their Reality Labs. Now, I've already talked about what I think about the metaverse, but basically, to make a long story short, I'm just not that impressed by it. I don't really think it's going to catch on, and for right now, I just don't really take it into account when I'm looking at Facebook's valuation. To me, it's still all about the ad business. Now, Facebook actually has a pretty interesting chart showing the daily active people, which is defined as the number of people who visited at least one of their apps on any given day. We can see that since December of 2019, Facebook has increased this number from 2.26 billion to 2.82 billion by the end of this year. Okay, so when we look at the current earnings forecast for Meta, the current expectations are for them to grow from about 101 billion in revenue and 39 billion in profits to 176 billion in revenue and 46 billion in profits by 2024. When we look at the revenue growth, it is much slower than what Meta has been doing in the past. However, net income growth is actually projected by 2024 to to be a little slower than their revenue growth, hitting only about 9% by 2024. So I think to value Meta, we should use a growth rate of 8%, which is a super conservative number for the bottom end of the range, and 12% for the top end of the range. This gives Meta a fair PE range between 18 for the bottom end and 26 for the top end. So when we look at this valuation charted out, I want to say that I am going extremely conservative in my opinion with that 8% growth rate, but Meta's current price of $237 per share is very cheap compared to what the company should be worth. By 2024, Facebook has an upside of $299 using a very conservative measure, and a high-end range of around $432 per share using a more moderate but still pretty conservative estimate. However, if earnings dip like the current forecast says during 2022, I do expect that Facebook's share price will stay lower. But also keep in mind that this is the low-end estimate, and if Facebook recovers better than expected, they definitely will exceed these returns. Now, I think that Facebook will figure out a way to adapt to the new privacy changes, and I think most of us recognize how good Facebook has been in the past when it comes to ad targeting, but at least for the next year or two, this is an obstacle that they're going to have to figure out how to overcome. So right now, I would say that Facebook is between a buy and a hold. It's definitely cheap, and I expect that the stock is going to rebound, but I think it may stay down if 2022 does report a decline in earnings in comparison to 2021. But if you don't care about this dip and you're entirely focused on 2024, this stock is of course a buy. Okay, so the next company on this list is Ford. Now, Ford had a pretty tough earnings report for the fourth quarter of 2021. Ford's earnings came in at 26 cents per share versus the 45 cents expected, and revenue came in at $35 billion versus $35.5 billion expected. Ford said that they missed their production targets because of the supply chain problems related to the semiconductor shortage. Ford said that they'll have to cut production of several key vehicles to deal with the lack of chips, including the Bronco, the Explorer, the F-150, the Mustang Mach-E, and the Lincoln Aviator. Ford's also been working to maximize production with what they have, but what stands out is the shortage must be pretty bad for Ford, at least for now, because they're cutting some of their most demanded and profitable vehicles like the Bronco, the Mach-E, and the F-150. However, not everything that came out was all bad. Ford estimated during 2022 that they're going to earn between $11.5 billion and $12.5 billion in pre-tax profits, which is about 15 to 25% higher than 2021. So this is very good guidance. On top of this, Ford actually came in as the second largest seller of EVs in the US in 2021. And of the 200,000 reservations for the F-150 Lightning, almost all of these reservations so far are converting to people physically ordering the vehicle. Now, when we put this quarter in context, we can see that this was a relatively poor quarter compared to the rest, but we can see that since the new CEO, Jim Farley, took over at the end of 2019, Ford looks like it's headed in the right direction. And when we look at the past 10 years of earnings, we can see that Ford saw a drop in revenue after 2020, but over the past year has turned a profit even with less revenue. Now, Ford hasn't put out a 10K yet, so I don't have the full earnings report as I make this video, but looking at the current forecasted earnings, we can see that the current projections for Ford are for them to grow from $134 billion in revenue and $2.8 billion in profits over the last year to $169 billion in revenue and $10 billion in profits by 2024. When we look at this revenue growth charted out, we can see that while Ford is probably going to see a lot of growth over the next couple of years, that growth will come down by 2024. But I think if we look to value Ford, we should use a growth rate between 3% for the bottom end of the range, and I'm going to go with 6% for the top end. I do want to point out that this is a little lower than what I previously used for the top end at 8%, and that's because we now have an extra year of forecasts that see a lower growth rate for 2024. So 3% growth gives us a fair PE value of 11, and a 6% growth rate gives us a fair PE value of 15. When we look at this valuation charted out, that currently gives Ford a 2024 valuation between 28 and 39 per share, which is about 58% and 116% higher than today's share price. I would say that Ford is very cheap, and the stock is definitely a strong buy after the dip. Okay, so the next stock on this list is Snap. Now, Snap had a wild week. After Facebook earnings this week, the stock fell about 18% because of fears that Snap would suffer because of Apple's new privacy settings. However, that was not the case. Snap beat estimates on earnings, revenue, and user growth, and they also recorded their first profitable quarter since becoming a public company. So Snap's numbers came in at 22 cents versus 10 cents expected, and revenue came in at 1.3 billion versus 1.2 billion, and daily active users came in at 319 million versus 316.9 million expected. Their average revenue per user increased to $4.06 per user versus $3.79 expected. So overall, this was an excellent report, especially when plenty of people were nervous that Apple would hurt the company more than expected. When we look at this quarter charted out, we can actually see that this was a pretty substantial amount of profit for Snap to make. Again, this was the first time that they reported as profitable since going public, and since they had to deal with the same challenges that Meta had to, it's pretty impressive. Snap CFO CFO also said during the earnings call that Snap has been mindful of making privacy inherent to its product, and as a result, the changes caused by the iOS updates are likely to be experienced differently for their business than for others. When we look at the last 10 years of revenue and net income, we can see that the company has been doing pretty well in terms of sales growth. And on top of this, we can see that Snap's losses have become more slight every year. So overall, this is a pretty good chart. So when we look at the revenue versus expenses, we can see that only a small amount of the revenue is actually eaten up by the cost of revenue. And we can see that most of the revenue versus expenses goes towards research and development. Now, Snapchat provides some pretty helpful charts, and the first one here shows their active daily users each quarter. We can see that Snap has done a pretty good job consistently increasing its daily users. When we dig a little further into this, we can see this chart that shows user growth broken down by area of the world. While they're still growing in North America and Europe, the rest of the world is where most of their growth is actually coming from. And the problem is that a new user in Mozambique, for example, not to pick on anybody in Mozambique, where the average annual income is around $460 a year, isn't as valuable to advertisers as the US, where the average income is around $66,000. We can see this in the chart Snap shows explaining their average quarterly revenue per user broken down by different parts of the world. The US is still the dominant revenue driver for the company, and surprisingly, Europe produces way less than I expected. However, it does seem like a European user provides about double the revenue a customer located in the rest of the world does. When we look at Snap's forecasted earnings, we can see that the growth is currently projected to continue, with 2022 expected to be the first profitable year for Snap, with revenue and profits expected to grow from $4 billion and a loss of $640 million over the past year to $10.7 billion in revenue and $2.7 billion in profits by 2024. So when we look at the revenue growth, we can see that Snap is currently forecasted to grow at 40 to 30% over the next few years. But the issue with using this to value them is if they're growing at a much lower rate by 2024, the stock is obviously going to trade at a much lower multiple by then. So I think an appropriate growth rate should be about 20 to 25% growth instead. So a growth rate of 20% comes out to a fair PE value of 53, and a growth rate of 25% gives us a fair PE value of 80. So when we look at this valuation charted out, we can see that Snap has a pretty insane amount of upside, with a 2024 valuation projected of $91 for the bottom end and a top end upside of $138 per share. Now keep in mind that this does depend on the forecast happening. Snap will have to execute its business operations very well to meet these numbers, but still so far they've actually done a much better job than I think a lot of people are giving them credit for. Now I know a lot of people are skeptical about Snap, so just for fun, I cut the PE ratios in half. So a valuation of 26 to 40, and even then Snap still has a lot of upside, with a 2024 valuation between 46 and 69, or 17 to 76% upside. So I do think that Snap is a pretty good buy right now, that the company is actually doing much better than people realize. And as long as they keep doing what they're already doing, I don't see any reason why the stock price won't be moving up over the next couple of years. Okay, so last but not least on this list is Amazon. Now Amazon reported its earnings on Thursday, and the company reported a huge beat, initially coming in at 27.75 per share versus the just $3.57 expected. But that's because the majority of these earnings are from a stake that Amazon has in Rivian, where it earned $1.3 billion. The adjusted earnings per share, meaning taking this big payment out, still came in much higher than expected at $5.80 per share. Revenue also came in slightly lower at $137.4 billion versus the $137.6 billion expected. Now, Amazon did report guidance that wasn't quite as good as expected. Amazon expects the revenue for the first quarter of 2022 to come in between $112 to $117 billion, which is short of the $120 billion that was expected. Now, even though Amazon missed revenue and guidance, because Amazon was able to beat earnings estimates, investors seemed a little bit relieved. Amazon has dealt with some higher than expected costs due to everything that's happened over the last couple of years. But Andy Jassy, Amazon's new CEO, says that even with these challenges, he feels optimistic about the state of Amazon as it emerges from the pandemic. Amazon also increased its Prime membership from $119 a year to $139 a year. Another big headline is AWS. The actual profit generator behind Amazon reported an increase of its profits by 40% during the fourth quarter, which is higher than what was expected. When we look at this quarter, we can see that the $5.80 that Amazon earned earned is actually pretty insignificant compared to what they have been making in the past. But I think the big reason Amazon's stock price has sat flat for the past year is the increasing costs they've had to deal with lately. And even though $5.80 in a quarter isn't much compared with the $42 they made per share over this year, because it came in higher than expected, it shows that Amazon may be dealing with costs a little better than what was expected. When we look at the last 10 years worth of earnings for Amazon, we can see that revenue has been highly consistently growing. And pretty unique to Amazon, this seems like one of the few companies that actually didn't see dramatic positive or negative changes during 2020, which is a little interesting since I think many people expected them to have a huge boost in sales. We can also see from this chart that Amazon has very slim profit margins, and in general, retail is pretty typically a low margin business, so we would expect this. When we look at their expenses compared with their revenue, we can actually see that only about half of Amazon's revenue is taken up by the cost of revenue, which Amazon describes as the cost to purchase products and shipping costs. Now, fulfillment, which actually cost a lot at $75 billion over the last year, is the cost to operate and staff their fulfillment centers. We see that fulfillment has increased from 15% of revenue to 16% from 2020 to 2021. While this is slightly higher, it's really not as dramatic as many people have been saying. However, because Amazon is a low margin business, this 1% change has a little bigger impact on their profits than other businesses would experience. When we look at Amazon's segments broken down, we can see again very clearly that North America is where the majority of the revenue comes from. But international does bring in a pretty significant amount of revenue too, with the last quarter bringing in $127 billion. However, the international segment brings in almost no profit, so this really isn't very valuable revenue. As I said earlier, the AWS segment is the biggest profit generator with $18 billion in profits over the past year. For comparison, the North American segment only brought in $7 billion during 2021, even though it generated $279 billion in revenue versus AWS only at $62 billion in revenue. Now, if we look at the current forecasted earnings for Amazon, the current expectation is for them to grow from $469 billion in revenue and $33 billion in profits to $725 billion in revenue and $59 billion in profits by 2024. Now, if we look at this revenue growth, we can see that Amazon is projected to slow down by 2024 with a projected 14% growth in that year. However, it is important to remember that profits drive value, and Amazon is one of those few companies where their revenue growth is really separate from how much profit growth they'll actually see. And this is just because AWS is what drives most of their profits and retail drives most of the revenue. When we look at their profit growth, we can see that 2023 and 2024 are currently projected to see 50 and 60% increases. So I think to value Amazon, we probably should split the difference between the two, and to value them, we should use a growth rate of about 26% for the top end of the range and about 22% for the bottom end. That puts Amazon's fair PE value between 62 to 80. Now, when we look over at macrotrends.net, we can see that this is roughly where they've traded since 2019. Still, if Amazon is able to see that 50% earnings growth, they should actually increase their earnings multiple, so this should be a fairly conservative valuation. So when we look at this valuation charted out, we can see that Amazon actually has way more upside than I had expected going into this, and it puts the current 2024 valuation between $7,309 and $9,430 per share, which is about 131% to 199% higher than the current share price. Honestly, this valuation increase is so high that I actually feel a little uncomfortable putting it out, but still the reality is if AWS can power Amazon to grow their earnings by 50% in consecutive years, this valuation is definitely accurate, and you'll absolutely see Amazon stock fly. Now, I do want to point out that 2022 is projected a slight earnings decrease, and if that's the case, we may not see much share price movement during 2022. But 2023 and 2024 should see big increases as long as the forecasts don't change. Now, keep in mind that the person Amazon picked to take over control of their business previously ran AWS since it was created. So I do expect that this part of their business will continue to do very well going forward. So Amazon is absolutely a buy right now. Okay, so to recap, here are all the stocks, their current prices, and the recommendations that I made on them. But before you go, make sure you check out this great video I have for you next. And as always, thanks for watching.